Okay, so you want to own an investment bank. No storefronts, no tellers, no drive-through ATM, no interest rate spread between what you pay depositors and what you charge borrowers. Just conference rooms, spreadsheets, and companies paying you enormous fees to help them raise money, buy each other, or sell shares to the public for the very first time. It sounds like the cleanest version of banking that exists. No deposits to protect, no loan defaults to worry about, just brilliant people in expensive suits closing deals and collecting fees that can run into the tens or hundreds of millions of dollars on a single transaction. Here's the problem. This business doesn't fail the way a retail bank fails. It doesn't fail because too many depositors show up wanting their money back at once. It fails because the confidence and the leverage that make it extraordinarily profitable in good years are the exact same forces that can destroy it in a matter of days when a bad year arrives. And understanding that distinction is the entire story of this industry. Let's start with what it actually takes to get into this business, because the barriers here look completely different from a retail bank. You don't need a banking charter in the traditional sense. You need to register as a broker-dealer with the Securities and Exchange Commission, join the Financial Industry Regulatory Authority, and satisfy a set of net capital requirements designed to ensure your firm has enough of its own money set aside to absorb losses before client funds or counterparties are ever put at risk. That regulatory capital requirement scales with the size and risk profile of your business, and for any firm doing meaningful underwriting or trading activity, it can require tens of millions of dollars in dedicated capital sitting on your balance sheet before you've advised on a single deal. But here's the detail that catches people off guard. The regulatory capital is almost the smaller problem. The real cost of entry is talent, and in this industry, talent is genuinely the product. A senior deal maker, a managing director with a deep network of corporate relationships, and a track record of closing complex transactions can command total compensation running into the millions of dollars annually, much of it in performance-based bonus tied directly to the fees they generate. Building a credible investment bank means recruiting a team of these people away from established firms, and that means matching or beating what they're already earning before you've generated a dollar of revenue yourself. This is fundamentally different from every other business this channel has covered. You're not buying land or a license or a building. You're renting the confidence of corporate executives that a specific group of individuals can get their deal done. And that confidence is entirely attached to the individual bankers, not to the firm's name on the door. Now, here's where the ownership landscape genuinely varies, and it's worth understanding because these different tiers behave in almost entirely different ways. At the top of the market are the bulge bracket global banks, the handful of massive firms with the balance sheet, the global reach, and the brand recognition to advise on the largest transactions in the world. Often the same firms that also run retail and commercial banking operations alongside their investment banking division. Then there are boutique advisory firms, smaller, highly specialized operations often founded by a handful of star bankers who left a bulge bracket firm to build something leaner, focused purely on advisory work without the balance sheet risk of underwriting or trading, competing on relationships and expertise rather than scale. Then there are middle market investment banks, focused specifically on advising smaller companies, the kind too large for a local business broker, but too small to attract attention from the biggest global firms. An enormous and often overlooked segment of the industry, given how many mid-sized companies exist compared to giant public corporations. And underlying almost every major securities offering is the underwriting syndicate model, where multiple investment banks join together to share the risk and the distribution work of bringing a large stock or bond offering to market, spreading both the fee and the exposure across several firms rather than one bank shouldering the entire transaction alone. Before we even get to how an investment bank generates revenue, there's a cost sitting on top of everything else in this industry that dwarfs almost every other line item, and it's the single most defining characteristic of how this business actually operates: compensation. At a typical investment bank, total compensation and benefits can consume somewhere between 40 and 60% of total revenue in a given year, an extraordinarily high ratio compared to almost any other industry on the planet. This isn't an accident or a sign of inefficiency. It's a direct structural response to the fact that the product this business sells is almost entirely embodied in the judgment, relationships, and execution skill of specific individual people. If you don't pay your top deal makers competitively, they leave for a firm that will, taking their client relationships with them. And a firm that loses its best bankers loses the deals those bankers would have brought in. This creates a genuinely unusual dynamic where a firm's single largest expense scales up and down almost in lockstep with its revenue, because bonus pools are explicitly designed to flex with how good or bad the year actually was. Second, compliance and legal overhead, which has grown substantially across the industry in the decades since the 2008 financial crisis triggered a wave of new regulation specifically targeting risk-taking at large financial institutions. Every major transaction requires extensive legal review, regulatory filings, and compliance sign-off, and firms maintain large permanent teams of lawyers and compliance officers whose entire job is ensuring the firm doesn't run afoul of securities law, insider trading regulations, and increasingly complex capital adequacy rules, none of which shrinks just because deal volume happens to be slow in a given quarter. Third, capital committed to underwriting risk. When an investment bank underwrites a bond offering or a stock issuance, it's frequently agreeing to buy the securities from the issuing company and then resell them to investors, which means the bank is temporarily holding genuine market risk on its own balance sheet during the period between agreeing to the deal and successfully placing the securities with buyers. If market conditions shift unfavorably during that window, the bank can be stuck holding securities worth less than what it agreed to pay for them, a real and sometimes substantial risk that sits underneath the underwriting business specifically. Fourth, technology and trading infrastructure. Modern trading operations require enormous investment in low latency systems, risk management software, and data infrastructure, representing a continuous, expensive arms race against competitors who are all trying to execute trades faster and manage risk more precisely than everyone else in the market. So, how does an investment bank actually make money given everything sitting on the cost side? The first and most classically understood layer is merger and acquisition advisory fees. When one company wants to buy another, or a company wants to sell itself, or a private equity firm wants to acquire a target, investment banks are hired to advise on valuation, structure the deal, negotiate terms, and manage the overall process. These advisory fees are typically calculated as a percentage of the total transaction value, and on a large enough deal, that percentage translates into fees running into the tens or even hundreds of millions of dollars for a single transaction, split among however many banks were involved in advising the parties. The second layer is underwriting fees earned when a bank helps a company raise money by issuing new stock or bonds to investors. When a company goes public for the first time through an initial public offering, the underwriting banks earn a fee calculated as a percentage of the total amount raised. And because IPOs and major bond offerings can raise hundreds of millions or billions of dollars at once, even a relatively modest percentage fee translates into enormous absolute dollar figures. The third layer is trading and market-making revenue, where the bank profits from buying and selling securities, either on behalf of clients or using the firm's own capital, capturing the spread between buying and selling prices, and in some cases taking directional bets on where markets are headed. This is genuinely the riskiest revenue layer in the entire business, because unlike advisory fees, which are earned regardless of whether markets go up or down, trading revenue depends entirely on the bank correctly navigating market movements, and a wrong bet at sufficient scale can turn what looked like a profitable trading operation into a massive loss within days or even hours. The fourth layer is asset management fees, where the bank manages investment portfolios on behalf of wealthy individuals, pension funds, and institutional clients, earning a percentage of assets under management as a steady recurring fee that provides a meaningfully more stable revenue stream than the deal-dependent advisory and underwriting businesses. And the fifth layer is prime brokerage, where the bank provides lending, trade execution, and custody services specifically to hedge funds and other large institutional investors, earning fees and interest income on the financing it provides to these sophisticated clients. Now here's the other side of the ledger, and this is where the industry looks fundamentally different from the retail banking business this channel already covered. Guaranteed bonus commitments made during boom years represent a genuine fixed cost obligation that persists even if the following year turns out to be significantly weaker, because top talent is often recruited with multi-year guaranteed compensation packages that don't automatically adjust downward just because deal flow slows. Lease costs on the kind of prime office real estate this industry requires, floors of Manhattan or London skyscrapers, are locked in for years regardless of quarterly deal volume. Compliance headcount, once built out to meet regulatory requirements, doesn't shrink meaningfully just because a particular quarter saw fewer transactions close. None of these costs move in step with revenue the way trading profits or advisory fees do. And that mismatch, expensive fixed obligations sitting underneath revenue that can swing dramatically based on market conditions and deal flow, is the exact same structural trap this channel has found underneath every asset we've covered, just wearing a very different looking suit. To understand how catastrophic like this can go wrong, we need to look at what happened to Lehman Brothers in September of 2008. And it's worth being explicit about why this is a genuinely different failure story than the retail bank collapses this channel has already covered. Washington Mutual and Silicon Valley Bank both failed because depositors, worried about the underlying health of the bank, rushed to withdraw their money faster than the bank could raise cash to meet those withdrawals. Lehman Brothers didn't take retail deposits at all. Its collapse came from a completely different mechanism: leverage on trading positions and short-term financing. Lehman had built an enormous portfolio of mortgage-related securities during the housing boom of the mid-2000s, financed substantially through short-term borrowing that had to be continuously rolled over, essentially refinanced again and again, sometimes overnight, in the wholesale funding markets. This worked perfectly well as long as lenders in those markets remained confident that Lehman was solvent and would be able to repay what it owed. But as the mortgage securities Lehman held began losing value rapidly through 2007 and into 2008, that confidence started to erode. Lehman's leverage ratio, the relationship between its total assets and the amount of its own capital actually backing those assets, had climbed to a level where even a relatively modest decline in the value of its holdings was enough to wipe out a huge share of its actual equity cushion. As losses mounted and rating downgrades followed, the firms and counterparties that had been rolling over Lehman's short-term financing every single day began pulling back, demanding more collateral or refusing to extend new financing at all. Without that continuous flow of short-term funding, Lehman simply could not meet its obligations. On September 15, 2008, Lehman Brothers filed for bankruptcy, the largest bankruptcy filing in American history at the time, involving more than $600 billion in assets. Unlike a retail bank failure, there was no depositor run in the traditional sense. There was a collapse of confidence among sophisticated financial counterparties who, almost overnight, decided the risk of continuing to finance Lehman's operations had become unacceptable. And once that confidence disappeared, the firm had no viable path to survive. Here's the structural lesson sitting underneath that story, and it applies to this entire industry, not just to one firm during one crisis. Investment banking runs on leverage, both financial leverage in the literal sense of borrowed money financing a firm's trading positions, and a more abstract kind of leverage built on confidence and reputation. In good years, that leverage is exactly what turns modest capital into extraordinary returns, allowing a firm to control positions and execute deals far larger than its own equity alone could support. In bad years, the exact same leverage means that a relatively small decline in asset values or a relatively brief loss of confidence among lenders and counterparties can wipe out a firm's equity cushion far faster than anyone inside the firm typically expects, because the math of high leverage cuts in both directions with equal force. This is the defining risk of the entire industry, sitting underneath every bulge bracket bank and every trading desk on the planet. Whether or not any individual firm happens to be pushing its leverage as aggressively as Lehman was in the years leading up to 2008. So does owning an investment bank actually work as a business? The honest answer depends enormously on the state of the broader deal and capital markets environment and on how disciplined the firm has been about matching its cost structure, particularly its compensation commitments and its balance sheet leverage, to a realistic view of how quickly that environment can shift. In the strong scenario, merger and acquisition activity is robust. Companies are confident enough about the economic outlook to pursue major transactions, and the IPO market is genuinely open, meaning companies looking to go public can do so at valuations that make the process worthwhile. Trading desks are generating consistent revenue because markets, while always carrying some risk, aren't experiencing the kind of extreme volatility that turns market making into a minefield. Asset management fees provide a stable floor of recurring revenue underneath the more volatile, deal-dependent businesses. In that environment, an investment bank can generate extraordinary returns on its equity capital, because the fee-based businesses, in particular, carry relatively modest capital requirements relative to the enormous fees they generate. And that combination, high fees against comparatively modest required capital, is exactly what has made this industry so consistently attractive to talent and capital over the decades, whenever deal markets are genuinely healthy. In the weak scenario, merger activity dries up as companies grow cautious about the economic outlook and put major strategic decisions on hold. The IPO market effectively closes because no company wants to go public into a falling or uncertain market where they'd be forced to accept a lower valuation than they could have gotten a year earlier. Trading revenue becomes genuinely unpredictable, sometimes spiking during periods of extreme volatility as clients rush to reposition their portfolios, but just as often producing losses if the bank's own trading positions move against it during that same volatility. Meanwhile, the guaranteed compensation packages signed with top talent during the previous boom year remain contractually owed regardless of how thin the current year's revenue actually turns out to be. And the prime office leases signed during more optimistic times don't get any cheaper just because deal volume has collapsed. This is not a hypothetical. It's close to exactly what happens across the industry during every genuine downturn in capital markets activity. And it's precisely the dynamic that turned Lehman Brothers from one of the most respected names on Wall Street into the largest bankruptcy in American history within the span of a single catastrophic week. The gap between those two scenarios, for what might look like two similarly prestigious investment banks from the outside, similar talent, similar client relationships, similar office addresses, can be the difference between one of the most profitable businesses in modern finance and one that's quietly, or in Lehman's case, not so quietly, running out of runway as confidence erodes faster than management believed was possible. And that's really the final thing to understand about this business. An investment bank looks like it's selling financial products, advisory services, underwritten securities, executed trades. In a narrow technical sense, it is. But underneath all of that sits something far less tangible and far more fragile than anything on this channel has covered so far. Confidence and access to the relationships and capital that confidence unlocks. A retail bank can survive a bad quarter of loan losses because its deposits are insured, and its business model is built around absorbing exactly that kind of gradual credit risk over time. An investment bank has almost no such cushion. Because the moment sophisticated counterparties and lenders stop believing the firm can meet its obligations, the short-term financing that fuels the entire operation can simply disappear. Not over months, but sometimes over a matter of days. The bankers, the deals, the trading floors, all of it exists on top of a foundation that isn't a vault full of money or a portfolio of performing loans. It's the collective belief of everyone the firm does business with that tomorrow will look enough like today for the whole system to keep working. Most years it does. And when it doesn't, the speed of the unraveling is the entire story.